Righto, boys, we asked. They deliver. It's the bloody shop to go to. Benjamin Cleary, Tribeca. Mate, thank you for taking us up on the offer. We've come in early for you, Cobber.
Thank you for having me, guys.
Yeah, well, mate, you are busy and you're taking up the Google search feed at the moment. Tribeca going activist on Glencore. Come out yesterday, mate. How long's it been in the making for?
Oh, look, we've held Glencore shares for around 7 years, and I guess we've been working with the company behind closed doors on some of our points in the letter for the best part of 12 months, and I guess we feel like now is the time, given there's a sort of number of short-term catalysts around what we're saying in our letter to be going public.
So Ben, that's an interesting amount of time. You say about 7 years, and in the document you put forward, it's been roughly 8 or so years since the multiple really compressed on Glencore. So previously, that 2011 to 15 period, you outlined that they had a superior valuation to the likes of BHP and Rio. So is it your view that the business has actually continued to materially become a better business since listing, and this multiple compression has really led to the 9% TSR that we've seen since listing?
Yeah, so as you say, the company's been listed 15 years. When they listed back in 20, or best part of 15 years, listed back in 2011, and when they listed, the company had a 30-40% premium on the rest of the mining sector. And that was largely attributed to the fact that a third of their valuation was from their trading business. Trading businesses generally, whether it's in Japan or America, even if you sort of back out Macquarie's trading business in Australia, you get about 12, 13 times, versus mining sector maybe on 6, 7 times. So it had that premium rating for the best part of 4 or 5 years. But you're right, in late 2015, 16, when concerns came around the company's ability to finance the trading business and letters of credit, etc., that's when their shares started to derate, and really they've been derating versus their peers since.
Ben, it's this obsession with what multiple you trade on that's kind of informed a big theme in the the diversified mining sector around reshaping the portfolio, and we see it with the likes of South 32. We see it everywhere. We see it with tech, which I think the re-rate's still absent as far as I'm aware. And the core of your pitch here is for Glencore to retain its coal. Its coal business. Why do you think that's a value accretive thing for Glencore to do, despite the wording to the market so far?
Look, I think in terms of the coal business and why we firmly believe companies should retain the coal business, and we should probably point out that the company have stated that they would hold a shareholder vote likely in the second quarter of this year to retain or divest coal business. Why we think we, as shareholders, very firmly support retaining the coal business, probably twofold. One is a financial consideration. One's more of a sort of ESG consideration. Financially, the coal business historically, whether it's a commodity or the earnings, have been a fantastic diversifier versus the metals and trading business. That's just a statistic fact that there is low levels of correlation between that earning stream and the rest of the business, which should add, in terms of a diversifier, a higher multiple to the shares going forward. I think the second thing is that Glencore have done a really good job, I think, in terms of pushing back from pressure from minority shareholders and louder views from some corners of the market to get out of fossil fuels. And we see that, we talk about it a lot to our investors, that and kind of make the point that this whole kind of ESG argument has changed rapidly over, and it's only really been sort of 3 or 4 years. If think back to Larry Fink's famous meeting with Greta Thunberg at Davos 2021, where sort of rumour has that he walked in, or 10 minutes before the meeting, didn't have really any idea what he was going to say. Someone mentioned, why don't you just say we're going to cut fossil fuels? And it kind of went from there. Mentioned that they were going to do that. 3 months later, $50 trillion of endowment funds, university pensions, institutional capital followed BlackRock down this path of divesting all fossil fuels. It was only really 12 months ago, early 2023, that BlackRock then came out and actually changed their policy and said, we're going to move away from divestment to more of a transitionary policy, and companies like Glencore that are transitioning their earnings away from fossil fuels towards electrification enabling commodities such as copper, zinc, etc., that they are doing, companies that we're going to invest in. But we're sort of now seeing an ESG 3.0, which is much more actually focused on the responsible stewardship of assets. And we think Glencore is probably the best placed company globally. Of all the diversified miners, we've seen most of the other miners actually sell their fossil fuel assets. Just so happens to be probably at the bottom of recent ranges as well from a price perspective, but sell their assets to less capitalised companies, to operators that haven't operated these assets for nearly as long or as efficiently. And you see that in the Australian market with BHP are now being lauded by investors and environmental groups for retaining the Mount Arthur thermal coal mine on the basis that they are a responsible steward. So
I'm not sure they had a buy for that one.
We think it's sort of a financial and an ESG consideration. Both of them are going to lead to stock trading on a higher multiple. And from a financial perspective, the Glencore's coal business is, between both met and thermal, is going to generate $4 or $5 billion of free cash flow for the next 20, 25 years. So it's going to be an absolutely fantastic business and diversify for the rest of the company.
There's a point to make on the symbiotic relationship that the coal business can have with the growth pipeline of the copper assets in a lot of ways, because those are giant projects that need an absolute boatload of funding in order to get up off the ground, and that funding dynamic is made a hell of a lot easier if you have the cash flow from the coal to fund those projects. Do you kind of see that if you just look at the say the copper assets without the ability to fund them that you get from the coal, that they're actually far less attractive as well?
Well, I couldn't agree more that if you look at Glencore's business, it's beautifully set up for the next 20 years, where you've got these bottom of the cost curve thermal and met coal businesses that have got about 20 years of reserve life left. You've got a metals business that is going to be capital hungry and needing or wanting to grow, and you've got a very stable trading business as sort of its keel.
Ben, I've just got one more on question one there. So retaining the coal business, and Gary Nagle, the CEO, has pointed to that being up for a shareholder vote if it goes that sort of way. Have you had engagement with the big shareholders, Ivan Glasenberg, the Qataris, and got an indication of whether they're willing to back this, keeping the whole unit together?
Yeah, we have. I think we're pushing on an open door there with most of the major holders. I think, as a holder ourselves, we just want to make sure we're putting our best foot forward and getting that public debate out there to make sure some of the smaller minorities as a group don't start to, go the other way. But I think in terms of the major holders, I think we're absolutely pushing an open door. And obviously, we are very aligned with the management team as minority holders with Glencore, that, Ivan Glasenberg and senior management own 20% of the stock. Obviously, they want to maximise their returns going forward. They're very smart people, and my feeling is they absolutely want to keep the coal themselves.
Right, we'll flash up the 4 points you put across to Glencore. We've covered point number 1 there, retain the coal business. Second is move to the ASX. So I guess parallel to what BHP tidying up their listing previously, and what you're pushing to get a bit of a re-rate on the ASX is a bit of a more natural home for a mining stock. What's the go with that?
Yeah, look, the point here is that London is just not the home of mining anymore. I think, when we sort of grew up in early parts of our career, it was. But over the course of the last 15, 20 years, it's just continued to get smaller on a relative basis to Australia and the US in terms of mining market capitalisation, and the multiples are woeful. So, at the moment, I think market capitalisation is about 30% less in the UK to Australia. But even probably more importantly, and I think to multiples, is that equity dollars raised in the UK is about 1 to every 10 in Australia over the last 5 years. So there's just absolutely no secondary market, primary market, I should say, activity at all in the UK. So there's just been a complete absence of new companies listing on the FTSE, and Australia has been clearly taking market share away from them, and that's resulting in higher multiples. So I don't think, again, we're pushing on anything other than an open door here. I think the company are obviously well aware of it, that the multiples on offer in the UK are nothing like Australia or the US. I think it's probably a decision which one, or is it a hybrid of both of those exchanges. But certainly, the FTSE and the companies there have derated. I think you mentioned earlier in the show with BHP delisting. BHP's share price in the UK, exactly the same company, was trading on a 25% lower value than what it was in Australia. As soon as they delisted, or announced the delisting, that discount closed to almost zero. And in the case of Rio, that's still listed, Rio's still trading in the UK today at a 25% lower price than it does in Australia. So it's fairly quantitative fact. We've done a lot of analysis in terms of sort of the flow in and flow back on a line-by-line basis, what we think would happen to Glencore if it was to move its primary listing to Australia, in terms of the flow out of local passive funds in the UK versus Australia, retail, pension funds, index tracking funds, and we see that there would be significant net buying of Glencore if it was to list in Australia.
But Ben, just on the point on which exchange, you've got the preference for ASX. Makes sense in some ways. You only got to stare at a screen from 10 to 4 then. So, but I got a question for you, mate, and that's why not the NYSE? Because you got deeper capital markets. You can create a comp to FCX over there. Would that not make more sense, or do you just see a multiple benefit on ASX?
Well, I think the company seems to be looking at the US as countless companies we've been invested in and being close to over the last 20 years have also looked at these US listings. Generally speaking, US advisors promise rivers of gold in terms of capital that can invest in companies if they have a quote in the US. I can't think of any company in the mining space that has benefited from moving a quote to the US, from the ASX or the FTSE in that period of time. Sure, I think there's been a couple of oil and gas companies that benefited in terms of pickup in volumes, but in terms of the mining space, I really can't see any real benefit. If I think the company were to go down the US track and that there was a big buy-in because of the trading business and the fact that there's comps in the US on the trading side, that'd be great. I guess my point is, in Australia, we can see very clear quantitative fact with BHP that them delisting in the UK, listing in Australia has led to sort of 30-40% multiple expansion. And in terms of flow back and flow in, the sort of impact that they had in the UK into Australia, kind of a really good recent example of what could happen with Glencore. So, yeah, look, I'm not, we certainly, we're global investors. We wouldn't be against them listing in the US if they could say that it was going to be an even better outcome than Australia. And maybe it's a hybrid of both.
Well, I assume the letter's not the first time you brought this up with them. Why has there been pushback on them, or what's their reasoning for not being on the ASX or anything just yet?
Look, I think that the D-rate has been happening for quite some time. I think my sense is that the company probably will engage and perhaps appoint an advisor sooner rather than later. I would say it's something that the company have been thinking about for quite some time. So hence, I think the timing's good. I think the other thing with listing in Australia that I guess is a benefit over the US is that if I look at Glencore's business in terms of the verticals they're in on the mining side, I think that two things that kind of stand out that they don't have in terms of scale from a commodity mining perspective is iron ore and lithium. And both of those verticals, really the majority of the global market cap is listed in Australia. And if we go sort of one step further and think about doing M&A in that space, I think that recent issue or transaction with Origin Energy and the takeover there being blocked by local super funds is a great anecdote as to why you do need a quote in Australia and paper in Australia to be able to do M&A, because these companies with large pension fund holders are just not going to engage if you can't offer rollover relief. And given that there is such a lot of market cap in the iron ore and lithium space, which is sort of obvious bulk commodities where Glencore isn't at scale, it's just another reason why having a quote in Australia makes a lot of sense. I think, the third thing in the letter that we talk about, which is paired at the hip with the Aussie listing and the multiple expansion that we think the company would see is the fact that they're paying about 40% of their tax on a global basis in Australia anyway. So over the last 5 years, they could have franked 100% of their dividends in Australia. And the ability to pay frank dividends is I think paired at the hip with that multiple expansion that they would see in Australia. Now, over time, the Australian tax paid is going to come down in all likelihood as the tech acquisition increases at a group level. But there is a very real ability to pay frank dividends at the moment in Australia. And I think without, going down rabbit holes, the tax system in the UK for retail investors and tax is an absolute joke. And Australia has such a fantastic tax system for retail investors and superannuation funds with franking that if there's an ability there for companies to pay them, you're going to get a big following. And hence, sort of, we go back to that sort of flow back and flow in analysis. We do see that there would be a very big take up of Glencore shares from retail investors in Australia on that basis.
So your final point there, Ben, on the document is centred around the trading business, and this is the one that is a bit sort of harder to take in a sense in Australia, in that, like you said earlier, there's no obvious comps, and the solution to that is selling a minority stake. Can you run through how you think about they would go about selling a minority stake, and perhaps who the rightful owner of a stake like that is?
Sounds like a haul road.
Capital recycling, mate. This is what the big guys do.
Yeah, the trading, Glencore's trading business has generated very stable returns since its IPO in 2011, and it's actually formed the basis of their dividend policy, and been actually a very reliable, very high quality earning stream for the business. And I guess, like other trading businesses that are listed, particularly the Japanese trading houses, the Sumitomo's and Mitsui's, Marubeni's, or other US listed trading businesses, companies like Arch Daniels or Bunge Group, these companies generally trading on anywhere from sort of 12 to 15 times, and that would also include the investment banks, the Goldman's trading units that have a sum of the part value of somewhere around that sort of 15 times. Macquarie on the same, and that is about a third of Glencore's value. And if you sort of think about, Glencore has just printed $17 billion of EBITDA, pretty much the cyclical trough for lots of the commodities that it's producing, thermal coal, cobalt, copper, zinc, they're all barely deflated at, well and truly into the cost curve. So it's sort of trading at not much over, 4 times EV/EBITDA. And so you're getting really the trading business on a like for like for free. And as a shareholder, I sympathise with management that they're doing a great job, but I sort of come back to the exchange. I'm sick and tired of owning these shares and not getting a re-rate for such a great business. So how do we realise some value here? Well, if we go back to why a company derated in the first place, in that sort of 2015-16 period, where there was some doubt came into the market about these letters of credit, because obviously the trading business does consume a lot of at call credit to be able to make the trades that it does. My suggestion is that something like the relationship that, for example, say Jefferies Bank in the US has with Mass Mutual, where they have a balance sheet, they're not a deposit-taking institution like the rest of Wall Street. They just have this large big brother, if you will, that stands behind them. There is absolutely no question of doubt that Jefferies credit is good at all time. Glencore could kind of do the same thing. We know for a fact that Warren Buffett, for example, Berkshire Hathaway, absolutely love trading businesses. They bought into Japanese trading businesses a couple of years ago. If they were to sell, say, 20% of the trading business at something around that 10, 15 times that the comps trading on, to a group like Berkshire that could then stand behind them as their forever money good balance sheet, then that, for example, would be a way that the company, I think, immediately puts that D rating in the mirror, in the rear view mirror, and starts to trade back up to something at or above their global peers.
Love the idea. I'm not sure Warren Buffett will pay full tote for it, but I love the idea. And there was a comment in your letter about their trading business, it becoming apparent that it's quite capital intensive as a result of that credit crunch back in the day. Look, why is Glencore's trading business capital intensive? Can you expand on that?
Well, I think it just goes to the nature of what they're doing in terms of taking offtake at the mine gate, selling contemporaneously to customers on the other side, financing those trades for very short amounts of time when the ore or the cargoes are on the water, as an example. Call it 30 to 45 days. So very sort of short-term trades, but you're having to finance the entire cost of those cargoes that have already been bought, that have already been sold. You own the infrastructure. Your risk on that trade is almost zero. It's a beautiful business in terms of a moat being around that business. Hedge funds like ourselves can't compete in that space. We don't have the infrastructure to enable us to compete in that trading business. I always make the point that even Elliott Advisors, which we were heavily involved with a campaign with some years ago on BHP, biggest hedge fund in the world. Even they couldn't make money out of nickel and the whole sort of issues that happened in the nickel market a couple of years ago. Sued the London Metals Exchange for $800 million and lost. So even very big hedge funds have struggled to really make money in the trading world, and why these businesses, the Glencores and Trafiguras, have built such big moats in terms of that infrastructure and those long-term offtakes that they've got, with their customers, are such beautiful businesses. But back to your question, in terms of the financing, it is because the dollar value of these cargoes, average cargo of copper concentrates, $50 million. You've got to finance that $50 million for 45 days to make a $1 to $2 million profit, pre-financing costs, etc. So you've locked that profit in. It's a great very low risk trade, but it does require a lot of financing. And so what happened in 2015-16, a lot of that financing was with European banks, which at the same time there was a bit, with the European banking crisis, if you will, your first letter of credit was with Credit Suisse, your second was with Deutsche Bank, your third was with UBS. So the market, not that this ever happened, but the market was kind of thinking, well, if one of them goes, the next goes. As banking contagion, then all of a sudden, Glencore are going to be offside with a whole bunch of trades, and going to be exposed to actual market direction of those commodities. Now that never played out, but my view is it's still in the market's mind. It's led to this derate that there could be this issue come back up, and hence if you did an IPO, or if you were to do a trade sale with a big brother, and I disagree with your comment there about Berkshire not paying up. I think they would absolutely pay up. This is a gold. This is a crown jewel in the world of trading. All things sort of electrification and battery feedstocks. I think, if the company announced a sales process, there'd be a mile, there'd be a list a mile long from, Middle Eastern, sovereign wealth funds to Asian sovereign wealth funds to groups like Berkshire that, would absolutely love to buy a stake in this business. And that would obviously then be able to supercharge the company's ability to do some counter-cyclical investment and to really ramp up their capital returns profile, which, I think is about the only thing that is stopping, a big re-rating from this company. So, yeah, look, I think, timing's good for for us to be going public with this. I think we're generally pushing on an open door on all 4 points. I think stock at £4, a share is just frighteningly cheap anyway in a historical context. I think, even if the stock was to move back to historical multiples, we see sort of 30% upside. If you go and do a bunch of the things that we're saying, I think it's more like a 50, 60% re-rate. And I think, if all of the things were achieved over sort of a 2-3 year, then there's at least 100% upside here. So, we're a small boutique, operation. We've only got 50 staff. We only manage $5 billion, but we've got to be able to target, these opportunities where we, get into the weeds and put significant capital at risk, for our clients. And we just see that, Glencore at this sort of £4 a share level is a no-brainer.
So what happens if they only come to the party on the first 3 points and retain the stake in the business? So I guess what's Tribeca do with that? You did your best, or you keep pushing for the fourth? What's the role of an activist and a big shareholder?
Look, I think that's the luxury. I always make the point, the luxury of running a fund versus running a BHP or a Rio or a Glencore. Like, they're the super tankers that it's pretty hard to do 180s, with these big businesses. But, you can certainly pivot and, implement these things. It takes time. It's not like running a hedge fund when you can go, long to short in a day and, move billions of dollars or significant percentages of your net asset value around in a matter of hours. I mean, it does take much longer, periods of time. But, we've sort of set this ladder up in, as we have done in other, situations where we've done the same thing with other companies in a kind of chronological order, where you think the coal vote, yes, yay or nay, it's going to play out over the next quarter. So that's pretty good. I think in terms of a listing, I genuinely think we'll get something, whether it's the US, whether it's Australia, over the next kind of 6 to 12 months. That's kind of paired at the hip with divvies and capital return policies, and obviously if point one is kept and they keep tech's met business inside the company, then that's really going to supercharge capital returns on a medium term basis anyway. And then I think with the trading business and the fact that we're, I think everyone's that I speak to, shareholders and company themselves, just frustrated that such a high quality business in the trading business doesn't get the multiple. So, I think it chronologically is kind of off for a reason, and it's probably more of a next year story. But, I would hope to see that, sometime in 2025 that we start to hear more from the company in terms of plans, for the trading business, if not earlier.
How confident are you, like, based on the engagement with them? And if they're not coming to the party, what's Tribeca just dumped the position? How do you really go from here?
Yeah, look, I think if there was just no engagement, no real update on the things that we've been talking about, then we'd have to reassess our views. I'm confident that that won't be the case. I really like the management team. It's sort of it isn't your usual activism angle for us, at least. That usually there's a kind of healthy amount of tension and a reasonably low scorecard for operation and management outcomes in the recent periods. That's absolutely not the case here. I think Glencore are actually operating their assets across the base metals and bulk businesses at about as lower operating efficiencies as any of their peers. So it's not really an operating issue. It's more of a corporate structure issue that we see, and I think we will get a good hearing and get a good outcome, and we're pushing on an open door.
There's one more way I think it's pretty unusual activism, and that is that I think you, the activist investor, actually want the same thing as the CEO, and that's to retain the coal business. I get the sense Gary wants to keep it. When I listen to the analyst call, like the way that he adds so much padding around the divestment, you really get the sense that he thinks the sensible thing to do is to keep the coal business. So maybe your pitch is not necessarily to management, but it's to the other shareholders.
100% right. Yeah, well, in my view.
We can leave it there, Ben.
Good on you, Cleary. Thanks for the time, mate. Buddy,
Thanks for having me.
Yeah, absolute pleasure.
Happy birthday, Matty.
Oh, thanks, mate. Go straight to the polls. Got to crack one at 6 a.m, but anyway, should be right. Right, Cobber.
Awesome, mate.
We'll talk to you in the future about it.
Have a good one.
See you guys. Bye.
Bye.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.